Hello, good evening, everybody. Thanks for having me. The danger of being the last speaker is that all your points are covered by the previous speakers. So I prepared a 14-slide presentation, and as you probably would see if I go through it, between Kelvin and Ishmael, I mean, it's totally gone. So I probably would just highlight on a few things. I'll talk a bit about myself, and a bit about Databank, and then I'll talk a bit about the capital markets and how perhaps SMEs could access financing. And by the way, if my voice goes a bit off, it's because of Ishmael's. My proximity to him caused that, yes. So my name is Ampa Sowa. I work with Databank. I've been there for 11 years. Was recruited fresh out of university as a research analyst. And, well, I've climbed up the ladder since then, been bumped up a number of times, went to school, came back, was made the head of research, and then about 4 years afterwards, I was made the chief investment officer. And what that means is that relating to all the funds that we have, I more or less am the final say in terms of making the investment decisions. We have assets under management of, I think, over 1.2 billion Ghana cedis. And there are a number of funds that we manage, some of which you might know. Who has heard of EPAC? Any of you have investments in EPAC? I hope so. Anyway, okay, so EPAC is a popular mutual fund product that Databank manages. It's one of my day-to-day jobs. Databank started in 1990, and in many ways, one might say that it was an SME before. It's hard to identify that now. Because back in 1990, when it started, there were just 3 to 5 people, and the startup capital was $25,000. And in terms of their office locations, it's not here on Barnes Road. It was in the middle of UTC, the market with all the market women and the like. So clearly, Databank can identify with the concept of SMEs and the like. Now, relating to my presentation, I think the few things that I would like to highlight. So yes, we talked, and I believe Ishmael talked a bit about the different types of financing options. There's a chart I want to show you. There's supposed to be a chart over there, basically showing the trend of the 91-day Treasury bill. I'm sure you know what the 91-day Treasury bill is. It's one of the bills that is issued by the Bank of Ghana on behalf of the Ghana government. The reason why that is relevant is that because it is issued by the government, the rate is more or less guaranteed, and as such is seen as the risk-free. Actually, there's no such thing as risk-free. Zero risk rated bill. Now, the chart that is not showing would have shown you that in recent years, that's averaged north of 20%. So what does that mean? It means if you're getting a guaranteed return from an institution such as the government, the minimum rate that that the government is borrowing money from you for is 20%. Now, this is a government that has, technically speaking, the right to print money and the like. So what do you think that would mean for private individuals such as you and I? What do you think that would mean for SMEs, unproven and unknown quantities such as yourselves? Do you think that the rates would be any cheaper? Certainly not. It is likely to be higher. So it is in that sense that some of the financing options that Ishmael talked about are very relevant. And some of the things that you also talked about are very relevant, relating to equity and even the types of equity and stuff and the types of investors that you get involved with. Now, what I'll probably focus on now, since there has been a lot of detail on the different financing options, I'll talk a bit about the Ghana Stock Exchange. Who knows where the Ghana Stock Exchange is? Right across the street. Okay, so about a little over a year ago, the Ghana Alternative Exchange was launched. The Ghana Alternative Exchange is basically, for those of you that have been to London, the equivalent of London's AIM, the Alternative Investment Market. And for SMEs, I think it's a very important source for raising capital. Why? Because you get a chance to float your company and raise equity for it. It differs from the main stock exchange where you see large and more recognizable names there, like the Standard Chartered and the Unilevers and the like. It differs from that because for SMEs, the requirements are a bit more watered down. So it's easy for you to access capital through that route. These are some of the key requirements that you would need. A company should be a public company, minimum stated capital of $250,000 Ghana cedis, minimum public float of 25%. So basically, the shares that should be freely available for trading should be about 25%. And then a minimum number of shareholders ideally should be 20. For SMEs here that are considering one day coming to market, I believe that this route would be very good for you. And it doesn't even need to be even equity. You could also issue debts there. In fact, the first set of companies that came on were the likes of the Easeway, AFB, and most recently even Bayport raised funds through that avenue. What I'll probably also do now, and yeah, that's the working capital that Michael was talking about. But I'd like to perhaps just round up. How am I doing with time? Round up by talking about some of the common mistakes that some of us have observed that SMEs make when it comes to investment options. So it's good for you to pay yourselves, granted, but when you do it at the expense of the growth of your company, then it becomes a problem. So ideally, when you're starting a company out, you have to give it time to grow. And what that means is that you might not have to, you have to deny yourself some of the pleasures and try and reinvest as much of the money as possible within the business so that it can grow. Because guess what? If that external financing is not coming, you have to use the internal resources that you have to grow your business. If you take too much of it from there, you curtail or you cut or restrict the growth of the business. Other things that we've also seen, and the last point over here, particularly on ownership, is a very common problem that we come across at Databank. So somebody wants money, somebody is even offering equity. And when you value the business, and the business is, say, $1 million, or maybe say even less than that, $500,000, and you are offering an amount of money, Ghanaian businessmen are so hung on control. They're so hung on control. And this is, what is in the parenthesis is a case in point. Your business is worth 100,000 Ghana cedis. So if you are a sole shareholder, you basically are worth, your net worth is about 100,000 Ghana cedis. Now, if I offer to invest money in it, and it would mean perhaps your share of the business being diluted to 10%. But the value of the business then gets to 10 million. What does that mean in terms of your ownership? Yes, it increases from 100,000 to 1 million. The only difference is that you now own 10%. But isn't 10% of 10 million much greater than 100% of 100,000? The math is quite simple. And we find that this is a very big problem that a lot of Ghanaian businesses kind of face. I think I'll end here now because my points are finished. Thank you very much.
Thank you.